Okay, so you want to own a car wash. Find a piece of land on a busy road. Install the equipment, run the cars through, collect the money. It sounds like one of the cleaner businesses available to a small investor. Low inventory, no spoilage, no complicated supply chains. A customer drives in dirty and drives out clean, and the whole transaction takes under 5 minutes. The machinery does the work. You own the machinery. The math appears obvious, and for a certain type of investor. The car wash has become the asset class of the moment, attracting private equity, family offices, individual buyers who look at the numbers and see something that resembles a toll booth with soap. One road in, one road out. Pay before you go through. The problem is, what happens when you actually pull apart how the money works, where it goes, what it costs to generate it. Why so many people who enter this industry with clean financial models end up with something far messier than they expected. The first thing to understand is the structure of the industry itself. This was because car washing is not one business. It is at least four entirely different businesses that happen to share a name. The self-service bay model, the oldest format, puts the equipment in the customer's hands. They insert coins or tap a card, pick up the wand, and wash the car themselves. The in-bay automatic is the single unit where a car pulls in, stays stationary. A machine moves around it. The full-service model washes the exterior mechanically, while employees vacuum and wipe down the interior. And then there is the express exterior tunnel, a conveyor belt system that pulls cars through a long enclosed structure at high speed, cleaning dozens of vehicles per hour with minimal labor. These four formats have radically different economics, different capital requirements, different labor profiles, and different ceiling revenues. Treating them as the same business is the first mistake most outside investors make. The express exterior tunnel has become the dominant format for institutional capital entering the industry over the past decade. The reason is throughput. A single tunnel running efficiently can process between 100 and 150 cars per hour, at a ticket price between $8 and $25 depending on the package selected. A busy site can generate between $800 several $1,000s per hour during peak periods. On a strong Saturday in a high-traffic location, a single tunnel wash can move over 1,000 vehicles through the system. Run those numbers across a full month and the gross revenue figures start looking very large. That is the version of the business that appears in pitch decks, and it is not fabricated. Those numbers are real. What is also real is everything pivoted, required to produce them. Before a single car enters the tunnel, the capital expenditure is substantial. A competitive express exterior tunnel facility requires equipment, real estate, construction, utility infrastructure that, in most markets today, totals between $3 and $6 million for a new build. The tunnel conveyor system and chemical delivery equipment alone typically runs between $1.5 and $2.5 million from major manufacturers. The real estate cost depends entirely on location, and location in this business is not a secondary consideration. It is the primary variable that determines whether the site succeeds or fails. A car wash on a road with 30,000 vehicles per day behaves completely differently from one on a road with 12,000 vehicles per day. Traffic count, visibility, ingress and egress, proximity to residential density are the variables that professional operators underwrite before anything else. In high-traffic suburban corridors, the land alone can push acquisition or lease costs into seven figures before construction begins. Here's the first structural reality that separates this industry from the mental model most buyers bring to it. A car wash is not a low-capital entry business. The version of the business that generates meaningful returns at scale requires millions of dollars deployed before the first car ever touches the conveyor belt. The self-service bay model can be entered for several $100,000. But the self-service format has been under sustained revenue pressure for 30 years. Customers who once spent 8 quarters on a wand wash now pay $12 for an express tunnel that does more in 4 minutes. Self-service bays still exist and still generate income, but their share of industry revenue has been declining consistently since the late 1990s. Any investor who enters the car wash business through the cheapest entry point is almost by definition entering the segment with the weakest growth trajectory. The second structural reality involves the membership model. That has transformed the economics of express exterior washes over the past 15 years more dramatically than any other single development. The logic is straightforward. Instead of paying per wash, customers pay a flat monthly fee, typically between $20 and $40 depending on the market and the tier. can wash their car as many times as they want during the month. For the operator, this converts unpredictable transactional revenue into recurring monthly revenue that arrives regardless of weather, regardless of how many times individual members actually use the service. An operator with 5,000 active members paying $30 per month generates $150,000 per month in membership revenue before a Le retail customer pulls into the lot. That revenue is largely fixed. It shows up every month. It can be modeled. It can be financed against. The membership model has also created a counterintuitive relationship between usage and profit. When a member washes their car 4 times in a single month after a muddy weekend, the marginal cost to the operator of that fourth wash is real, but relatively small. The chemical cost per car at a high-volume tunnel operation typically runs between $1.50 and $3.00 per vehicle, varying with chemical package selection and volume purchasing agreements. The labor cost per car, when spread across the throughput volume a busy tunnel produces, is comparably modest. So the wash that costs an operator $2 to deliver and is sold as part of a $30 monthly membership has already been largely paid for regardless of frequency. The break-even usage rate for most membership tiers sits where between 1 and 2 washes per month. Members who wash once a month are highly profitable. Members who wash 4 times a month are still profitable, just modestly less so. The real risk in the membership model is churn, not overuse. Churn is what the industry calls the rate at which members cancel. A site with 5,000 members and a monthly churn rate of 5% loses 250 members per month and must replace them just to stay flat. A site with 3% churn loses 150 per month. The difference between a 3% and a 5% monthly churn rate, compounded over 12 months, has enormous implications for membership revenue trajectory and ultimately for what the business is worth when it comes time to sell. Operators who can demonstrate sustained churn below 3% command meaningfully higher acquisition multiples than operators running the same volume with 6% or 7% monthly cancellations. The membership count is not the only number that matters. The stability of that count is equally important. When investors value a car wash business today, the reference metric is EBITDA, the operating earnings before interest, taxes, depreciation, and amortization. A single express exterior wash generating strong membership revenue in a high-traffic location can produce annual EBITDA somewhere between $800,000 and $1.5 million, depending on market, execution, and membership penetration. In the acquisition market that developed between roughly 2018 and 2022, buyers paid between 8 and 12 times EBITDA for individual sites and between 10 and 15 times EBITDA for regional chains with standardized operations and demonstrated membership growth. At 12 times EBITDA on a site producing $1 million in annual operating earnings, the acquisition price is $12 million for a car wash. That number surprises people outside the industry. It no longer surprises the private equity firms that have been aggressively consolidating the fragmented landscape of independent operators for the better part of a decade. The consolidation trend is worth understanding because it has changed the competitive environment in ways that individual operators did not fully anticipate. Between 2019 and 2023, private equity-backed platforms acquired hundreds of independent car wash sites across the United States. These platforms operate under names like Mr. Car Wash, Magnolia Car Wash, Splash Car Wash, among many others. Mr. Car Wash went public in 2021, becoming the first publicly traded car wash company in the country. With a portfolio of over 400 locations, the strategic logic behind the roll-up is familiar. Larger operators achieve lower chemical costs through volume purchasing, spread corporate overhead across more sites, access cheaper financing, invest in technology that smaller independents cannot justify. A regional chain negotiating chemical contracts covering 150 locations pays a fundamentally different price per gallon than an independent operator with 2 sites. This matters for the individual buyer entering the market today, because the competitive landscape they are entering is no longer primarily composed of other independent operators. In markets where a well-capitalized regional chain has established locations, pricing pressure is real. Express tunnel washes compete heavily on price, convenience, and brand recognition. A new independent operator entering a market where an established chain is already running a membership base of 8,000 customers at nearby locations is not simply competing for car wash customers. They are competing for share of a membership pool that an established operator has already captured with lower churn, higher brand awareness, more sophisticated loyalty infrastructure. Now, here is where the operating cost structure becomes important. This was because the gross revenue of a busy tunnel site is impressive, and the EBITDA margin that remains after expenses is considerably less impressive than the top line suggests. A high-volume express tunnel generating $2.5 million in annual revenue typically operates with total costs somewhere between $1.1 and $1.8 million, depending on labor market conditions, chemical costs, real estate expense, and equipment maintenance burden. Labor is the first major line item. Despite the automation of the tunnel, a car wash requires staff to guide vehicles onto the conveyor, manage the exit area, address customer issues, keep the equipment running cleanly. A typical express exterior site in a mid-sized market employs between 8 and 15 people across all shifts, with total labor costs running between 15% and 22% of gross revenue. Chemical costs are the second major recurring expense, and among the most actively managed line items in the business. The detergents, waxes, tire shine compounds. Rinse agents consumed in the tunnel represent between 8% and 14% of gross revenue, depending on volume and supplier relationships. Operators running high wash counts negotiate volume discounts that meaningfully reduce their per-car chemical cost. An independent operator washing 80,000 cars per year pays a noticeably higher price per unit of chemical than a chain washing 800,000 cars across 10 sites. This is a structural cost disadvantage that small operators carry relative to large ones. It compounds across every cost category that benefits from scale. Equipment maintenance is the expense that catches most new operators most off guard. A tunnel conveyor system runs continuously during operating hours, processing vehicles at high speed through a series of brushes, high-pressure water systems, and drying equipment. The mechanical stress is substantial. Belts, brushes, pumps, and sensors require regular replacement. Hydraulic systems need constant monitoring. A major equipment failure during peak operating hours on a Saturday has direct revenue consequences that are immediate and quantifiable. The industry standard maintenance reserve is typically between 3% and 5% of gross revenue annually, but sites with older equipment or higher throughput volumes frequently exceed that range. An operator who defers maintenance to protect short-term cash flow is building a cost that will arrive eventually, and arrive with interest. Utilities represent a further significant operating cost that first-time operators routinely underestimate. A tunnel car wash consumes large volumes of water. Electricity. In colder climates, natural gas for heating the wash water and preventing equipment from freezing. A busy tunnel in a northern market can use between 500,000 and 800,000 gallons of water per month during peak season. Many markets have invested in reclaim systems that recycle a portion of rinse water, reducing consumption and, in markets with high water costs, improving operating margins. The electricity draw from high-pressure pumps, dryers, lighting, and climate systems is similarly substantial. In markets where electricity prices have risen sharply in recent years, utility costs have increased as a percentage of revenue. For operators whose pricing structures were set before those increases took effect. Real estate is the largest fixed cost for most operators, and the one with the most direct relationship to performance. A site on a high-traffic road in a wealthy suburb commands a land lease or ownership cost that reflects its revenue potential. A site on a less trafficked road in a lower income area costs less to occupy, but also produces less revenue. The challenge is that the revenue difference between a strong location and a mediocre location is not linear. A site with 35,000 cars per day passing in front of it can produce 2 or 3 times the membership count of a site with 18,000 cars per day, even if both sites are equivalently built and priced. The real estate premium paid for superior traffic exposure is almost always justified by the revenue differential, but only if the operator has accurately assessed the traffic profile and conversion rate before signing the lease. Here is a trap that costs car wash investors meaningful money in markets they do not know well. Traffic count is not the same as convertible traffic. A road that carries 40,000 vehicles per day in an industrial corridor, where most of those vehicles are commercial trucks, is not the same as a road carrying 25,000 vehicles per day past a grocery-anchored retail strip. Car wash membership tends to over-index among commuters, suburban homeowners. people who wash their vehicles regularly for appearance reasons. Sites positioned along routes that serve that demographic perform better than sites on roads with higher raw counts, but weaker demographic alignment. Operators who buy on traffic count without understanding what kind of traffic they are looking at frequently discover this distinction on no. Why? After the site is open and membership recruitment is running well below pro forma. The pro forma document, the financial projection prepared by brokers and sellers to illustrate the investment opportunity, is where the gap between car wash investing theory and car wash investing reality most reliably appears. A pro forma for a car wash acquisition will typically show gross revenue at or near peak capacity, a membership count at or above stabilized levels, expense ratios drawn from industry averages rather than site-specific history, an EBITDA figure that supports the asking price. None of these elements are necessarily false. They represent a scenario in which everything is functioning at a level the seller wants the buyer to believe is normal. What the pro forma rarely shows is the capital expenditure required to replace aging equipment, the churn rate behind the member boss, ship count, the trajectory of competition entering the market, or the water and utility cost increases that occurred after the trailing 12 months of financials were compiled. Buyers who accept pro forma numbers without verifying them against actual site-level data have paid prices that the real operations cannot support. This is not unique to car washes. It is how overpriced acquisitions happen in almost every industry. But the car wash market of the early 2020s created particular conditions for this problem. Aggressive consolidation drove acquisition multiples upward. Cheap financing allowed buyers to pay prices that required optimistic revenue assumptions to underwrite. Sellers with well-run sites were motivated to sell into a strong market, and buyers with capital that needed deployment were motivated to acquire quickly in a sector that had produced strong returns for early movers. The combination produced a wave of transactions in which the purchase price as calibrated to a version of the business that, in a significant number of cases, the site was not capable of producing. The debt load carried by many of those acquisitions became a structural problem when interest rates rose sharply beginning in 2022. A car wash acquired in 2021 at 12 times EBITDA, with 70% debt financing at 3.5% interest, carries a very different annual debt service than the same site refinanced or acquired in 2023 at 7% interest. The operating cash flow that once comfortably covered debt service and still returned equity to the owner may, under higher rate conditions, cover debt service with little margin remaining. The business has not deteriorated. The financing structure has become more expensive relative to what the operations produce. This is the interest rate trap, and it is not specific to car washes. It is how leveraged acquisition economics work across all asset classes. The car wash industry in the mid-2020s is working through the consequences of a period in which the capital flowing into the sector pushed valuations above what the underlying operations could sustainably support at normalized financing costs. None of this means that a car wash is a poor investment. It means that the investment thesis depends heavily on the specific site, the specific market, the capital structure of the acquisition, the operational competence of whoever is running the business on a daily basis. A well-located, well-operated express exterior tunnel with a stable membership base of 4,000 or more members, managed by an operator who understands chemical procurement, equipment maintenance, staff retention, can produce consistent returns over a long holding period. The business has genuine structural advantages. Water usage is generally lower per unit of revenue than most manufacturing operations. The product cannot be delivered online. The demand is recurring and relatively stable across economic cycles. This was because people wash their cars in recessions as well as in expansions, though they may trade down from premium packages to basic washes during periods of financial stress. The recession resistance of the car wash business is frequently cited by proponents, and it is partially accurate. During the 2008 financial crisis, car wash industry revenue declined by approximately 12%. That was considerably less severe than the declines experienced by restaurants, retail, and discretionary services. During the early months of the COVID-19 pandemic in 2020, contactless car wash formats, particularly express exterior tunnels, recovered faster than full-service models because the contactless nature of the tunnel was actually viewed as a feature during a period of heightened concern about surfaces and human contact. The industry is not recession-proof, but its correlation to economic downturns is weaker than most consumer-facing businesses. That is a meaningful characteristic when underwriting a leveraged acquisition over a 10-year horizon. The operational dimension of the business is where investors with a purely financial background most commonly struggle. A car wash is a manufacturing operation in the sense that it runs equipment continuously, manages consumables, requires preventive maintenance on a defined schedule, depends on the reliability of mechanical systems for its revenue production. An investor who thinks of the business as a passive income stream deploying capital and collecting returns is going to discover that the operation requires active management or a highly capable general manager who can handle equipment vendors, chemical suppliers, staffing issues, customer complaints, the daily variability of a high-throughput service business, the margin between a well-managed site and a poorly managed site, measured in EBITDA, is frequently the difference between a business that services its debt and a business that does not. Labor management is particularly consequential. The car wash industry draws from a labor pool that is heavily hourly and experiences meaningful turnover. A site with chronic staffing shortages runs slower, processes fewer cars per hour, fails to maintain the exit area to the standard that retains members, accumulates deferred cleanliness issues that members eventually notice and cancel over. The connection between employee retention and membership churn is not intuitive to investors who have not managed the business directly, but operators who have run sites for multiple years identify it immediately. The sites with the lowest membership churn are almost uniformly the sites with the most stable, well-compensated frontline staff. The sites with the highest churn frequently trace the problem back through customer experience to staffing instability. The multi-site operator has a genuine structural advantage in labor as well as in purchasing. A regional operator running 10 sites can offer frontline employees a career path that a single-site operator cannot. They can move workers between locations, promote from within, and build a management structure with real advancement opportunity. They can also absorb the loss of a key employee at one site by temporarily deploying staff from another. A single-site independent operator who loses their general manager faces a crisis that a 10-site operator faces as an operational inconvenience. This is one of the reasons that single-site operators, when offered fair acquisition prices from regional consolidators, frequently accept. The operational burden of competing against well-capitalized chains is real. The exit opportunity that consolidation created gave independent operators access to liquidity at valuations that would not have been available in an earlier era. The question for the individual investor today is where the opportunity actually exists within this landscape. Buying a single existing site in a strong location at a reasonable multiple defined as something below 10 times trailing EBITDA, with verified membership data and a documented equipment maintenance history, remains a legitimate investment thesis in markets where chain competition is not already saturated. Developing a new site from greenfield on land with demonstrably strong traffic counts and limited immediate competition is higher risk but potentially higher return, particularly if the developer can bring the site to stabilized membership penetration within the first 12 to 18 months of operation. Both paths require capital, patience, and operational attention that a purely passive investor is not positioned to provide. The economics of a car wash business, stripped of the promotional version that circulates in investor communities, look like this. Capital requirements are high, particularly for the format with the strongest revenue ceiling. Location determines performance more than any other single variable. The membership model produces the most valuable and most stable revenue, but requires active management of churn to deliver the returns it theoretically promises. Operating costs are real and include labor, chemicals, utilities, maintenance. Real estate expenses that collectively consume between 45% and 65% of gross revenue at most sites. The EBITDA margin that remains, typically between 30% and 45% for a well-run express tunnel, is attractive relative to most small business investments. But the acquisition multiples paid in the recent market frequently required that margin to be delivered at a scale and consistency that not every site and every operator can achieve. There is a regional chain in the Southeast that operated 14 tunnel locations in 2019, grew to 31 locations by 2022. By 2024 was in active negotiations with lenders over covenant violations on its acquisition debt. The individual sites were not failing in an operational sense. Several of them were producing memberships and wash volumes consistent with what had been underwritten. The problem was the aggregate debt load carried across the portfolio, taken on at a period of peak valuation and subsequently burdened by rising financing costs that the operating cash flow distributed across 31 sites could not comfortably service. The sites were performing, the capital structure was not,